Welcome students to another lecture in the series. Let us move ahead with the further concepts of ratios. Okay, now let's begin with the turnover ratios today. So we do have the first ratio as fixed assets turnover ratio. You know very well that this is the ratio which indicates the efficiency. This ratio indicates the efficiency with which the firm is utilizing its investments in fixed assets, such as plant and machinery, land and building, etc. Means whatsoever is the investment done by the organization in fixed assets, how is it being utilized by the firm is being shown by this particular ratio. For this, we do have the formula sales or either cost of sales as per it is given in the question divided by the net fixed assets. Net fixed assets refers to the depreciated value of fixed assets. Significance and objectives of this ratio. In general way, we can say a high ratio indicates efficient utilization of the fixed assets in generating the sales. Means that the organization is using the fixed assets in a efficient manner, whereas a low ratio would signify that the firm has an excessive investment in fixed assets and they are not utilizing it in a proper manner. Here we have a small question on the basis of this. The following details have been given to you for Messrs. Reckless Limited for 2 years and you are required to find out the fixed assets turnover ratio. You may see that they have given you the data of 2 years 1997 and 98. It is seeming to be a bit old, but here it's not about the year, it's about the understanding of the particular ratio. So as they have given us sales less returns, so we will use the formula sales. Otherwise, if cost of sales could have been given, we could have used the formula cost of sales upon the fixed assets. After calculation, you can see we have put the values here and we are able to obtain that in 1997 it was 4 times, whereas in 1998 it decreased to 2.67. Though if you see the absolute value of sales had got increased, it was 6 lakh in 1997, whereas it got increased to 8 lakh in 1998. But why the ratio is declining? Because the amount of assets has gone double in 1998. So there has been a decline in fixed assets turnover ratio, though the absolute figures of the sales have gone up. It means that increase in the investment in fixed assets has not brought about commensurate gain, means that it has not brought about the equivalent gain. However, the results for the next 2-3 more years must also be considered on the judiciousness or otherwise of the increase of investments in fixed assets. Means to decide whether this investment almost making it double was judicious or not. So we need to see more results for that. And fixed assets turnover ratio can further be divided into turnover of each item of fixed assets to find out the extent each fixed assets has been properly used or not. So in that case, you can just simply use it as per the particular asset. Like this one, plant and machinery to turnover, the formula would be net sales upon the net plant and machinery, means after depreciation. Same way as land and building to turnover, so the formula would be net sales upon the net land and buildings. So it would go on like that. Let us move further. The second important ratio that we have here is the working capital turnover ratio. This is also called as working capital leverage ratio. This ratio basically shows you whether or not the working capital has been effectively utilized in making sales or not. In case a company can achieve higher volume of sales with relatively small amount of working capital, so it indicates its operational efficiency. So it will always be appreciated if there are higher volume of sales and there are less amount of working capital being used for it. So the formula here that we will be using would be net sales upon the working capital. Further, if we go and move further, now we are about to start an important set of your ratios, which in general comes in your exams. Working capital turnover ratio may take different forms for different purposes. Some of them we are about to study. First is debtors turnover ratio or debtors velocity in this. Kindly remember the names of the various ratios that are being discussed here. Debtors constitute, you know that they are an important constituent, important part of your current assets, and therefore the quality of debtors to a great extent determines the firm's liquidity. So, two ratios are used by the financial analysts to judge the liquidity of the firm. First is the debtors turnover ratio, other is the debt collection period ratio. So to begin with, debtors turnover ratio, the formula here we are about to use is credit sales upon the average accounts receivable, and here average accounts receivable includes the trade debtors as well as bills receivable both. Let us have a look to a question on this. We need to calculate the debtors ratio. The total sales are given as 1 lakh, cash sales as 20,000, debtors as 10 lakh, debtors as in closing date is 15,000, BR open 7,500, bills receivable closing because it's given as on 31st December, it's 12,500. So first of all, let us calculate the average bills receivable, average receivables basically. So we can add the opening balances, that is the opening debtors 10,000 and opening BR of 7,500, so 17,500, and the closing debtors and closing BR, that is 15,000 plus 12,500, so 27,500. Added both of these, so because this is the opening balance, this is the closing balance divided by 2. From here you can get the amount as 22,800. Credit sales are given us in the question because total sales is 1 lakh and cash sales is 20,000. So 80,000 is the credit sales which is given to us. So the ratio is coming out as 3.56 times. So in case details regarding the opening and closing receivable and credit sales are not available, the ratio may be calculated like this: total sales upon the accounts receivable. The significance of this particular ratio is that sales to accounts receivable ratio, it shows the efficiency of the staff who are interested in the collection of your book debts, that how efficiently they are able to collect the debts. So higher the ratio, the better it is. Why? Because it would indicate the debts are being collected more promptly, more timely. For measuring the efficiency, it is necessary to set up a standard figure. A ratio lower than standard will indicate inefficiency. So the ratio helps in cash budgeting, since the flow of cash from customers can be worked out on the basis of sales. So it is very helpful in cash budgeting. Next ratio that we have discussed, debt collection period ratio, is another important part here. This actually is the period for which in which you're paying, like you're able to enjoy the credit from the market. So this ratio basically indicates the extent to which the debts have been collected in time. It gives the average debt collection period. The ratio is very helpful to the lenders because they will be able to get to know that how much credit period they can enjoy from us, because it explains them whether their borrowers are collecting money within a reasonable time or not. An increase in the period would result in greater blockage of funds, so we are never interested in increasing this period. We would like to keep this period as low as possible. So the ratio may be calculated by any of these formulas. Somewhat these formulas are similar. Let's try and understand how. Months or days in a year, as the situation may be, as it is given in the question, upon the debtors turnover, if the debtors turnover is given to you. Otherwise, you can just put the formula of debtors turnover here. You can see it is being put here, credit sales of the year, and the average accounts receivable from the denominator has moved to the numerator. So first and second, both the formulas are almost same. The third is the average accounts receivable upon the average monthly or daily credit sales. Now let us have a look how to apply this concept numerically. You can have a look. Credit sales are given to us, debtors are given to us, BR is given to us. We need to check out the debtors turnover ratio and debt collection period ratio. So first we can see that credit sales upon the accounts receivable. We can see credit sales is given as 12,000 and debtors is 1,000, BR is 1,000. So we have used it and found out is 6 times. From this we can calculate the average collection period, or you can say average age of receivables. Please remember these names. Months in a year upon the debtors turnover. So we are able to obtain 2 months. If you wish, you can use the other formula as well, accounts receivable into months in a year upon the credit sales. So it will also again come out as 2 months, because the formula is actually same. The only difference between these formulas is that here we are using the debtors turnover value, whereas here we have put the values of the formula. That's it. It is otherwise same. Now the significance of this particular ratio, it is even calculated here with the third method. Again it is coming out as 2 months. So you can see that the ratios are interrelated, because debtors turnover ratio can be obtained by dividing the months or days in a year by the average collection period. So similarly, where the number of months or days in a year are divided by the debtors turnover, average debt collection period is obtained easily. Now let us see the significance. debtors collection period measures the quality of the debtors, since it measures the rapidity or the slowness with which the money is being collected from them, that how promptly they are making us payments. A shorter collection period would show that they are very prompt at paying. It reduces the chance of bad debts, whereas if you are having a longer collection period, it shows that they are too liberal or either they are inefficient in paying the credit to us back. Inefficient credit collection performance is shown. So, however, in order to ensure the firm's credit and collection efficiency, its average collection period should be compared with the average of the industry, so that you will be able to get that how your firm is being performing in the industry. It should be neither too liberal and too restrictive, because both the things are negative somewhere or other. Because if you are too liberal, people will take for granted, and maybe that you would have higher bad debts in that case. But if you're too restrictive, then people might not be able to interest in buying the product from you. Why? Because it will, because you're not giving them credit period. So in that case, it can lower down your sales and can reduce your profits. So it is very difficult to provide a standard collection of debtors, and it depends basically upon the nature of industry that you're having, or the seasonal character of your business, or the credit policies of the firm. And in general, the amount of receivables should not be actually more than 3-4 months of credit sales, not more than that. Let us see further what we have. Then we have the creditors turnover ratio. These ratios are alike as of the two that we have just studied. On the previous pages, we have studied debtors turnover ratio. Here we have just opposite of that. That is your creditors turnover ratio, creditors velocity. It is similar to debtors turnover ratio. It indicates the speed with which the payments for credit purchases are made to the creditors. We can see the formula: credit purchases upon the average accounts payable. And same ways, here also accounts payable includes the trade creditors as well as the bills payable both. In case the details regarding the credit purchases opening and closing accounts payable have not been given, then in that case we can use this formula as well. That is the total purchases upon the accounts payable. Both the formulas can be used if the information is not exactly given in the question. Now next is the counterpart of this one, that the debt payment period enjoyed ratio, or you can say average age of payables. This ratio gives you the average credit period that you are able to enjoy from your creditors. It is computed by any of these three formulas. The formulas are almost similar. The first is months or days in a year upon the creditor's turnover. In the second formula, you just need to put the formula of creditor's turnover in it. So average accounts payable into months in a year upon the credit purchases in the year. The last one is also similar to the debtors one, average accounts payable upon the average monthly or daily credit purchases. Here we have another numerical question. Let us have a look to it. We need to calculate the creditors turnover ratio and the average age of accounts payable. We are given with credit purchases as 1 lakh, creditors opening balance 20 lakh, bills payable opening balance 4,000. So 24,000 will be the opening. We will be using it on the next page. Remember it. And creditors as on 31st December is 10,000, bills payable is 6,000. So total closing is 16,000. Let us see the next page. We can see the credit purchases. We have put the formula. We can have calculated the average accounts payable by adding both the opening and closing and dividing it by 2 as 20,000. Credit purchases as 1 lakh. So the ratio is coming out as 5 times. Now let us see how to calculate the average age of the payables. Months in a year upon the creditors turnover coming out as 2.4 months. With the other two formulas also you can calculate and see and cross verify it. Then the significance, both the creditors turnover ratio and debt payment period enjoyed ratio indicates about the promptness or otherwise in making payment of the credit purchases. It actually shows the promptness with which we pay to our creditors. A higher creditors turnover ratio or a lower credit period enjoyed ratio shows that creditors are being paid promptly. So thus enhances your credit worthiness, which means that people will be ready to pay you the give you the material on credit. However, a very favorable ratio to this effect also shows that the business is not taking the full advantage. So it's not good to have a very low creditors turnover ratio. So you must take the full advantage of the credit facilities which can be allowed by the creditors from the market. Next we have inventory turnover ratio. This is another important ratio. Other name is stock turnover ratio. Formula is quite simple. Cost of goods sold upon the average stock or inventory. Cost of goods sold can be calculated by two methods. First is sales minus gross profit. There is another important concept from your financial accounting: opening stock plus purchases plus the carriage inward if it is given in the question minus the closing stock. An average stock will be just opening and closing divided by 2. We can use the alternative methods if figures are not available. In that case, inventory turnover ratio can also be calculated by dividing sales by the average stock at selling prices. Inventory turnover ratio can also be calculated by dividing sales at average stock by average stock at cost. Accordingly, we can use it as per the information given in the question. Let us have a look to a numerical based on this. Opening stock is given as 29,000, purchases are given, sales are given, and gross profit is given. So we need to check out here. We can first of all see what is the closing stock. We have calculated it. We have marked opening stock, purchases, 25% of this sales as gross profit. Sales are being mentioned and the balancing figure is 31,000 is calculated as the closing stock. Now let us see how to use it to calculate the stock turnover ratio on the next page. You may see we can find out the cost of goods sold. Accordingly, an average stock and put it in the question in the formula and find it out at 8 times. Now let us see the next important part, that is your significance. The inventory or stock turnover ratio basically indicates the efficiency of a firm's inventory management, that how efficiently we are able to manage our inventory. This ratio gives the rate at which the stocks are converted into sales and then into cash. A low inventory turnover ratio is an indicator of dull business, accumulation of your inventory, that it is lying down in your go down and you're not able to sell it out. So over investment in inventory or unsaleable goods are being shown in that case. So generally we can say a higher stock turnover ratio is considered to be better because it shows that more sales are being produced by each rupee of investment that we have done in stock. But a very high stock turnover ratio may not always be an indicator of a favorable result because it may show a very low level of stock, which results in frequent out of stock positions. So such a situation prevents the company from meeting the customer's demand and the company cannot earn maximum profits. So thus too high and a too low inventory turnover ratio may not be considered as good and should be investigated further. A company should have a proper inventory turnover ratio so that they are able to earn a reasonable margin of profit out of it. The next we have in the series is capital turnover ratio. This is the very basic ratio because it gives you the relationship between the cost of sales or sales with the total capital employed. So the formula is this only, to cost of sales or sales, whichever is given in the question, upon the total capital employed. The total capital employed here refers to all the long-term liabilities and the total shareholders funds. For this, you are supposed to deduct non-operating assets like investments if there are any, and fictitious assets like preliminary expenses from it. So the total capital employed can be calculated as equity share capital plus preference share capital plus reserves, debentures, long-term loans. And we need to find minus the fictitious assets like preliminary expenses or discount on issue of shares, and we need to subtract the non-operating investments also. So it should be noted that your capital employed here and that we are about to use in the next part of ROI is same. यही same that we will be using the same thing there also. The significance here, this ratio shows the efficiency with which the capital employed in a business is used. A high capital turnover ratio shows the possibility of greater profit, and a low capital turnover ratio is a sign of insufficient sales and possibility of lower profits. So it is always advisable to have a higher capital turnover ratio. Here is a numerical where you can find out the fixed assets turnover ratio and capital turnover ratio. You can check out the material given here in the liability side and the asset side of the balance sheet and use it accordingly to put it in the formulas that are being taught in the previous pages and calculate the values and match it up. If you have any query regarding this, you may write to me. Then further, I'm about to teach you working capital leverage ratio in this class. Working capital leverage ratio indicates the way in which the profitability and return on investments are affected due to the working capital management. Basically the overall return on investment, that is ROI. It depends on two basic things. One is your net profit ratio and the other is the capital employed turnover ratio. Capital employed constitutes the fixed as well as working capital. The overall return on the capital employed depends on both on these NPR as well as turnover ratios. So return on investment will therefore be affected by a change in any of these. If net profit margin is being changed, it would be affected. Same as with fixed capital, working capital, and the total capital employed. Now let us understand this using the next example. The profit margin of a company is 10% and the assets turnover is 3 times. What is the ROI, because return on investment of the company? By what percentage will the company's return on investment will increase or decrease if these four possibilities are given to us? Let us see each possibility one by one. At this moment, the return on investment we can calculate as 30%. Why? Because the profit margin is 10% and assets turnover is given to us 3 times. So it is at the moment, without any further changes, it is 30%. But now they are asking us to increase the profit margin by 2%. So profit margin is 10%. So we need to increase it by 2%. So it will become 12%. If you multiply it by 3, that is your assets turnover, so the return on investment will come out as 36%. So it has got also increased. If you are increasing the profit margin by 2%, you can see your return on investment is increasing by 6%. Same ways, you can find out the difference and put it and show it. In the second part, they are asking you to decrease the profit margin by 2%. So it was 10% originally. Now here we have used as 8%. So 8 into 3, 24%. This means that if you are decreasing the profit margin by 2%, it will further decrease the return on investment by 6%. You can see here it has gone down minus 6%. Now let us see if we change the assets turnover, how it would affect. At this moment, the original assets turnover is 3 times and profit margin that we were using is 10 times. But now here we need to increase the assets turnover by 1%. So it would become 4 in place of 3. So 10 into 4, 40%. You can see that if you increase the assets turnover by 1%, it is further increasing your return on investment by 10%. Such a huge increase. Return on investment, on the other hand, if it is being decreased by 1%, it will affect the same ways negatively on your return on investment. It will get decreased by 10%. I hope all the concepts are clear. If you people face any query, if you face any doubts, you may write to me. You may contact me. Till then, take care. Bye bye.